You will get to know the 9 money mistakes almost everybody makes. These mistakes keep them poor. The ninth mistake has made many people poor. So keep watching this video till the end to know it. Now let's start. Number 1. Maintaining an unstructured budget or lacking a budget entirely. A frequent error in financial management is failing to establish or uphold a practical budget. A budget serves as your financial guide, steering you toward accomplishing objectives such as buying a home, lowering debt, or enjoying a well-deserved vacation. Nonetheless, the effectiveness of a budget is directly tied to the commitment you invest in it. Creating a budget is a great first step, but if you haven't been monitoring your daily income and expenses, it may not be serving its purpose effectively. Alternatively, if your financial plan neglects certain easily overlooked expenses, such as annual car registration fees or holiday gifts, or fails to accommodate for occasional discretionary spending, adhering to it may prove challenging. It's important to allocate time for a thorough review of your finances and enhance your budgeting strategy. A solid guideline for creating a budget is the 50-30-20 rule, allocating 50% for essential expenses such as housing, transportation, and healthcare. Allocate 30% for discretionary spending, such as entertainment and similar activities. Allocate 20% towards savings, debt repayment, and investments. The percentages can be adjusted as needed. Allocating more than 20% of your income to savings can significantly enhance your financial well-being in the long run. Consider utilizing a budgeting application that seamlessly tracks your expenditures and assists with calculations. Number 2. Lacking a robust emergency fund. Many individuals in the United States lack sufficient savings to manage an unexpected expense of $1,000, whether it be for a broken water heater, necessary vehicle repairs, or an emergency medical visit. In the event that you encounter an unforeseen expense and find yourself unable to cover it, consider exploring alternatives such as seeking assistance from family or friends, or utilizing a credit card with a higher interest rate. An emergency fund is crucial for financial stability. It is advisable to make regular contributions. For many individuals, this involves allocating a segment of each paycheck towards an emergency account for savings. It's advisable to set this up with a direct deposit to ensure consistency and to minimize the risk of spending those funds impulsively. To determine your savings goal, assess the amount required to cover your household expenses for a period of 3 to 6 months. It is essential to ensure that this amount is consistently accessible in your emergency fund. Now, subscribe to our channel and also press the like button to help us hit our first 10,000 subscribers target, and we will bring something special for you all. Number 3. Not maximizing your financial opportunities. Is your employer providing matching contributions for your 401k retirement plan? Are you presented with the chance to purchase shares at a reduced price? Ensure you take advantage of every opportunity available to maximize your financial benefits. Numerous employers provide a 401k program as an integral component of your benefits package, and several will match your contributions to a certain extent. When your employer provides a match for your contributions to retirement up to 3% of your income, not utilizing this benefit is akin to declining a portion of your salary. It's important to designate a beneficiary for any life insurance or comparable benefits provided by your employer. Your benefits package is an integral component of your overall compensation. It's essential to optimize your potential benefits. Number 4. Neglecting life insurance. Contemplating one's mortality is often an uncomfortable subject for many individuals. It's essential to proactively plan for the financial security of your loved ones in the event of unforeseen circumstances. The typical expenses associated with a funeral amount to approximately $8,300. Life insurance provides your family with the financial support needed to manage expenses in the event of your passing, ensuring they have the necessary resources to navigate a challenging transition during that time. For adults in good health, life insurance can be quite affordable, and the reassurance it provides is invaluable. Ensuring that your loved ones possess the necessary resources to flourish in your absence is a prudent decision that can provide peace of mind. Number 5. Failing to compare options for significant investments. When evaluating substantial expenditures like car insurance, home loans, or appliances, it is common for individuals to stick with their first option. However, evaluating your options is essential. By evaluating options in areas such as insurance, mortgage rates, electronics, or travel deals, you can potentially reduce your annual expenses significantly. The introduction of online comparison tools and applications has significantly simplified the process. Regardless of your loyalty to a specific brand or company, it's prudent to consistently assess the market to guarantee that you are securing the most advantageous deal available. Number 6. Persisting in payments for unused subscriptions. Are you aware of all the monthly services you are currently subscribed to? A significant number of individuals often overlook the impact of unused memberships and subscriptions on their finances. The typical American utilizing streaming services allocates approximately $552 annually for this entertainment expense. Regularly reviewing your bank account can help you identify and manage recurring expenses such as gym memberships or streaming services, allowing you to save money effectively. There are applications available that can assist in identifying subscriptions to cancel and can even handle the cancellation process on your behalf. Although individual payments might seem small at $10 or $20, they can accumulate to hundreds of dollars over the course of a year. Evaluate the frequency of your usage for each service to determine if the cost is justified. Number 7. Acquiring a new vehicle. It's important to consider more than just the monthly payment when deciding to purchase a new car. Vehicles are assets that lose value over time, indicating a decline in worth as they get older. It's important to be aware that a new vehicle may depreciate by as much as 20% within the initial year of ownership. The rate of depreciation tends to decrease after the initial 1 or 2 years, making a pre-owned vehicle generally a more cost-effective option compared to a brand new one. Numerous manufacturers provide certified pre-owned vehicles, generally ranging from 2 to 3 years in age and featuring low mileage. These programs typically encompass a comprehensive vehicle refurbishment, along with a manufacturer's warranty. By opting for this choice, you can enjoy the benefits of a new vehicle at a significantly improved value. The only trade-off is the absence of that new car aroma. Number 8. Excessive reliance on credit cards. A credit card serves as an effective instrument for establishing your credit history. However, a substantial credit limit may lead to overspending and financial strain. It's important to understand that the minimum payment typically only addresses the interest accrued. Utilizing your credit card wisely can yield numerous advantages, but it's essential to steer clear of excessive debt. However, if you currently have substantial credit card balances, there are still opportunities for recovery. It may be beneficial to explore the option of an online personal loan or a credit card that offers a low balance transfer interest rate to effectively reduce those outstanding balances. Next, seek out a credit card that offers a robust rewards program, along with a competitive interest rate for your daily expenditures. Ensure that you pay off the balance each month to enhance your credit score. Number 9. Overlooking your credit report. Neglecting your credit profile can lead to significant financial repercussions. It's a common error that many individuals encounter. When assessing your eligibility for a loan, lenders will review your credit report to decide if they are comfortable extending credit to you and under what conditions. Almost 99% of people commit this mistake and remain poor. Avoiding this is also very PLE. Just pay off your debts, and if you can't do this, starve for it. If you think you are in the upper class, then watch the video appearing on the left side to know the signs that show you are already in the upper class. These signs are really spotted in less people. So watch this video to know whether you have it or not. Also, subscribe to our channel to know more on personal finance.